Hello and welcome to Crypto CFOs. My name is Taylor Zork, and this is our weekly Water Cooler Wednesday. We've got Stacey Ferris, Tom Mays, Brendan Santiago, and Ryan Whalen on the call. We're going to do a discussion about the 2023 kind of crypto tax FAQs and also do some predictions on what's to come for 2023. Well, when I say 2023, I really mean 2022 tax season. Anyways. So just to kind of kick off the conversation, some of the kind of frequently asked questions that I've seen on specifically this crypto tax Reddit and some other places across the internet are kind of things like, how can I legally reduce my crypto taxes? How is crypto income taxed? Which crypto tax software should I use? And other things like this, and like things around the ETH merge. So one of the things I wanted to just jump in on right off the bat is kind of how you can legally reduce your crypto taxes kind of after the end of the year, right? Like, is there anything that you can do to do that? And there are a couple things. If you haven't already established a method of accounting for your crypto assets, you could choose a accounting method that's more advantageous to you. And generally, well, by far the most advantageous one is specific ID. Now, this is obviously a lot more cumbersome, but you can reduce your taxes by quite a bit if you specifically identify the cost basis that you're associating with different and holding periods you're associating with different sales of crypto assets. So that's one really big way that you can reduce your crypto taxes. Specifically spec ID. If you don't want to use spec ID, there's some other default methods that are allowed if you have elected specific ID. So pretty much anything is allowed if you've elected specific ID. And some of the best ones that are kind of generally used on the different crypto tax prep softwares are LIFO or HIFO, so last in first out, or highest in first out. So those are some of the default options that a lot of different crypto tax prep softwares use. So those are some really great ways to reduce your taxable income after the year is closed. And then, as we've talked about before, you can implement tax loss harvesting strategies, especially because although it's up in the air, I'm of the belief that wash sale rules don't apply to crypto. Now, NFTs are a little bit more tricky to determine that, but if you aren't buying back your crypto within a 30-day window before or after the sale of your crypto, you can just harvest the losses and not worry about the wash sale rules altogether. So those are some high-level trading strategies. I wanted to kind of put it out to the group to see if anyone had any questions that I hadn't addressed already, just in the initial kind of overview. There were any others that they had seen or thought about or were, kind of expecting from people this tax season?
So I got a question for you on, like, you were mentioning like the LIFO, HIFO and all that. If you were, let's say, if you were subjected to an IRS audit, wouldn't the IRS say like, oh, you need to be consistent from one year to the next unless you have justification for changing that methodology? So it's not just like you can just like, oh, well, this year actually using HIFO works better for me.
No, you have to use your historical method, and that's definitely for you have to. Generally, the default is FIFO if you haven't like specifically elected one. However, you can't just on a whim change it year to year. You can change it asset to asset, but you can't change it year to year. So that's a great point to clarify there, Stacey.
By default, if you choose specific ID, specific ID can become FIFO, right? Mm-hmm. So maybe you make a note on the tax return that you've adopted specific ID as your method of accounting, and they don't have to do a change of method of accounting going forward, as long as you choose specific ID, which is by default whatever you want it to be.
Yeah, so the only thing to be aware of is that you have to inform whatever software you're using each year of what your historical method is. And if you are using spec ID and you're just kind of associating things with the best outcome, you have to ensure that that's taken into account when you're using crypto tax software. Stacy, what were you going to say?
Could one of you explain a little more what specific ID means? It's not a term I'm familiar with.
Yeah. So specific identification is when you are taking, basically it's an inventory method where you can assign specific as units come in, if you can identify them separately and each have their own cost basis, you can then choose which ones you're assigning to sales. So each sale has a proceed and a cost basis, right? And with something like HIFO, you would take the highest in and use that as the first one out. However, with Spec ID, you could choose any of the incoming cost bases to assign to the proceeds of that sale. So you can kind of match it on a whim. Now, there's no crypto tax calc software that can do it in the most advantageous way for you. So you have to be sure that you are tracking it. I do it in a spreadsheet when I do Spec ID because it's just, then I can keep track by color coding which ones I've used up, so I don't double use them. So Spec ID requires a lot more legwork, but it is by far the most advantageous because you can control exactly which cost bases you are assigning to each sale.
Yeah, that seems like it's only really possible if you have kind of a relatively simple structure. Once you get over a certain volume, it turns into a bit of a nightmare to track that.
Yeah, but Spec ID opens the door for you to use something like HIFO, which isn't specifically identified as an acceptable method. But if you elect HIFO, you can, if you elect Spec ID, you can use something like HIFO, which a lot of the crypto tax softwares allow for. Yeah, Tom?
To me, oh, sorry.
Oh, hey, I was just going to say, so this is a great topic, Taylor, because a lot of people will be doing their crypto taxes for the first time, and they won't know what tax regime to apply here. And as you mentioned, you can apply, almost any rule as long as you have some rationale behind it. So my question would be, what do you think is the best way of going about that? Because you could assess all of these rules on an individual basis, but they may be relevant for year one, but when your company enters year 2 or year 3 and you're planning to increase your exposure to crypto assets, what do you think is the best tax regime, going forward? What do you think is the best or the safest option to do it, or how to evaluate that?
Yeah, specific ID kind of gives you a free for all. If you adopt that from the beginning, you get to choose, which purchases you're going to match against which sales. And even if you by default use a software that does FIFO or LIFO, you're still in compliance with specific ID. And I believe the IRS FAQ on crypto, on virtual currency, allows you specific ID, right, Taylor?
Yeah. FIFO and specific ID are the ones allowed. Now, on piggybacking on your point, as I said before, like if you either switch crypto tax softwares or you go from doing it in Excel on your own and then go into a crypto tax software, you got to make sure that things are handled consistently, right? So if you've already been doing it one way, you need to make sure that the crypto tax software is accounting for things in the same way that you that have been done previously, so that you're not double using kind of cost basis or holding period information from prior purchases. So
yeah, I mean, so a change in method of accounting requires, in some circumstances, and I actually don't know if there's any guidance on crypto, but if you look up the IRS form 3115, there's a revenue ruling associated with it that tells you in which circumstances you need IRS permission to change your method of accounting. Some you need their permission, some it's automatic. And that's probably something we should take a look at and see if, I guarantee it doesn't address crypto, right? Whether it's automatic or something you can make the change yourself.
Mhm. I'm not sure about that. We'll get the answer to that after the call, unless someone else knows. Yeah, so that's what I would recommend from that standpoint. If it's available to you, spec ID, because it leaves the door open. So that's why it's crucially important of tax preparers to be certain of what system to use. I know that a lot of crypto tax preparers in at least webinars that I've taken have recommended FIFO because it's the easiest for them. But ultimately, and because if you don't have that information directly from the client, it's kind of the safest bet. However, it's not always going to give your client the best tax picture. In fact, it's most likely not going to give them the best tax picture because it incentivizes more recent sales, more recent cost basis and holding periods. So it kind of moves you away from long-term capital gains from a likelihood standpoint. A couple of other things that I wanted to mention as far as like legally reducing crypto taxes. So transaction fees are subtracted from the proceeds, right? And transfer fees are added to the cost basis of the asset. So, and then gas wasted on failed transactions, that's a capital loss. So it's important to know how to classify these different transaction fees and how those can kind of impact your tax liability. Also, if you margin trade, margin interest and fees are deductible up to your net investment income. So if you're looking, that's from a retroactive kind of standpoint. And as Stacy noted, you can't go ahead and change this once it's been set. So this is only if it's a new asset that you're trading, because you can do different elections per asset, or if it's your first time trading crypto in general, you can set these after the year closes, obviously, before you file your taxes. Now, proactively, we've talked about tax loss harvesting and other discussions as well, but yeah, it's still up in the air about whether that's going to be allowed in 2023, but it was allowed in 2022 as of right now. That's still on the books. So I have seen arguments where people have stated that they do believe the wash sale rules also apply to crypto. So that's kind of a judgment call. And if you can extend that period between when you sell and then buy back, it's more effective because then you're showing an actual economic difference in when you buy and sell, right? Because if you just sold it and then bought it right back, you're not really changing your position at all if it's immediate. If it's been a day or if it's been a couple days, that's a significant amount of time in the crypto world. So I think that is exposing you to an economic risk. So something to be aware of from the tax loss harvesting standpoint as well. I'm just checking the chat because I saw some messages come through. Yeah, so Tom posted in the chat that Bitwave could do spec ID accounting, and that is true that some of these tax softwares can do spec ID. However, the whole point most people use these crypto tax softwares are the main reason for using them in general is that they speed up the process. And if you have to identify each and every cost basis that you're assigning to each sale, it's cumbersome, right? So if you have thousands of trades, it's not a realistic thing to use. So that's kind of how I look at it, but definitely something to look into there.
So in a tax software, if you use specific ID, if you opt into it in the particular software, like I'm going to match this purchase to this sale, and you do it for a select few, and then you don't make a specific selection for the rest, is it going to default to FIFO or LIFO or some other method?
So I've actually never seen it offered on any of the ones that I've used. So Tom mentioned that Bitwave allows for it within their software. I haven't actually seen it as an option. The only options I've seen are like FIFO, LIFO, and HIFO. I know other countries allow for average. So I've seen that on the crypto tax calculator that we demoed with the other day. I'm not sure if they allow for it. I would guess that they probably do have a feature where you could do that as well, but I'm not positive about that. So yeah, there's a challenge there. You could have the software if they are allowing for spec ID. I mean, a good feature would be for you to opt into doing some of them yourself and then defaulting the rest to whatever's not been used as hypo or something like that.
Yeah.
But I don't know of the capabilities of specific tax softwares like that.
Yes. So I guess the true question is, what is the default? If you choose some and neglect the rest, where are they going to default to? So maybe
Yeah.
that's a question to ask Bitwave.
Yeah, yeah. I'm meeting with them in a couple of weeks, so I'll ask them that. So another kind of topic that I've seen asked a lot is on that same topic of crypto tax software is like, which one should I use? And ultimately, the answer to this question is going to be, which one supports the different accounting methods that you want to use. So if you want to use HIFO and tax software you're using, or if you've used that historically, if it doesn't offer that, then you're obviously not going to use that software. Some software that I have experience with directly are coin tracking and Coinly. Those are great if you're kind of like more, I would say more of the average crypto user. They have really good functionality. We just demoed crypto tax calculator, and that one is the most robust I've seen from like if you're a degen and you're doing DeFi and you're doing bridges and you're doing tens of thousands of transactions a year. That one's really good for that from what I've seen. But I'm curious to know if anyone else has experience. I know Tom specifically has experience with a bunch of different tax calculators, and I'm wondering if he could weigh in.
Yeah, sure. So actually for my company, for Pluto, we use coin tracking. And what we like about coin tracking is it is all encompassing, and it does kind of allow us to move between different tax strategies. Incidentally, we do FIFO, but for us, the kind of the pluses are that it covers an awful lot of cryptocurrencies, and we get involved in a lot of altcoins, shall we say? So we do find it good for that, and also the reports and the APIs that can spit out from it are fantastic. Now the kind of limitations we find are around NFTs. It struggles to recognize NFTs. The guys over there are building a module for it, but I think this is going to be one of the big problems. You talk about specific IDs. That's effectively how we manage our NFT portfolio. We have to manage it on spreadsheet. It's not able to do. It's not able for it to be done within the system yet. But effectively, it's the same method. You're getting this specific cost on a specific day, and you're calculating when you sell it, or it's to get its realized value, or you're looking at its unrealized value and carrying that forward. It's I think software's got an awful long way to go, and I think it's kind of a help and a hindrance for us as accountants. It helps us in the sense that people are going to run to us because it's incredibly hard at the moment to do that from an NFT perspective, as well as a crypto perspective. But I do think the rules around this are going to become more and more solidified, and I think that the UX around it will only improve. So yeah, I've got experience of other systems, Coinly, as well as Crypto.io. I don't know if you guys have heard of those. They're a French company. But again, they all suffer with the same problem. Although their UX is considerably better, they just cannot cater for altcoins or NFTs.
Yeah, I think the NFT thing is a real challenge. I did see when we were doing the demo on Crypto Tax Calculator, they did have some features for that, which was interesting to see. I don't do a ton of NFT trading, so we were using my wallet as the example. So it wasn't the best example to test out the capabilities of it from an NFT perspective, but that's definitely going to be, I think, a hot button topic for a lot of these crypto tax calculators, is that they need to be able to integrate this, because that's how a lot of people got into crypto in 2022 or 2021 even, is from NFTs. And I think there's a lot of people that are trading that are going to have some major capital losses in the current year.
Yeah, and there are some great products out there that can track NFTs. NFT Bank is a DApp. that could be used that can track NFTs. And if you've done all the transactions in one wallet, it will give you a realized and unrealized gain for each of your assets purchased in there. But yeah, you're right. It's a kind of gray area that people just aren't thinking about at the moment. But when they come to selling them during the next bull run, I imagine there's going to be a lot of complications there.
Yeah, and I think that a lot of accountants see this, these crypto tax softwares as kind of like a silver bullet. Like if they're not into crypto, they're just like, okay, just fill out your information on this crypto tax software and just send me the report that it spits out. And I think that's a really, well, I think it's not the best way to handle things, especially because, like we've talked about before, it's ultimately the quality of the information that you put in determines how good of a result you get from these reports. And none of the exchanges have the capability of knowing what your cost basis is on the items that you didn't purchase on their exchange. So if you're transferring assets into Coinbase, for example, and they came from Kraken, or they came from a DeFi wallet, or they came from, like some sort of other
Cold wallet
source, cold wallet or whatever, then Coinbase and Kraken, they'll send you a 1099, but they don't know the cost basis of assets that you transferred in. So
You can get
that can be scary.
that's right, if you transfer in.
Yeah.
So I'm not a tax accountant. I am a CPA, but I'm an auditor, right? That's my background.
Mhm.
So I'm just kind of laughing a bit through this whole conversation. I'm a little amused because I'm thinking, you can do what I do, which is get the Excel report from Coinbase,
Mhm.
write
That's
down
what I
all
do.
the other transactions you have in that thing and send it to your tax accountant.
Oh no.
No, that's the reason
no.
we
I know you know how to do this.
no, that the whole reason that we exist is because that doesn't work.
Well, it's
Yeah.
worked so far. I haven't been audited, and I've been, owning and trading cryptocurrencies for like the last 3 years that I've had.
You might be shortchanging yourself because your basis is understated.
I don't know. I really don't know. There's not a lot of transactions, which is
Mhm.
the upside. I'm one of those hodlers, I tend to like buy and just kind of hold on to stuff, right?
Yeah.
So, but I have noticed like it does get pretty wonky and confusing when you have like, God, when you get over like 10, 20 transactions in a year, a few different
Yep.
coins, different wallets. So
Well, I mean, I was working for TrustSwap, and we were doing like launching projects. So I have all these kind of random coins and split allocations and all this. So my stuff was very complicated, and I was still doing it in Excel. And 80 hours of work later, I had my report ready for my own filing. But that's why I've been focused more and more on getting these tax softwares to work for the more complex individual who has, maybe they don't have 30,000. I didn't have that many transactions at like in the tens of thousands, but if you don't have a way to kind of effectively assign cost basis and track those things within a software, it's a nightmare. And I think
what do you think is like
lose-
the threshold for someone to say, it's getting complicated enough that I really need to get like tax software. Maybe I need to get a professional to help me. At what point do they kind of say, okay, this is more than I can handle. I need to make sure I'm doing this right?
Well, so I would say that the biggest thing is when you start to get into DeFi, if your cost basis info isn't populating into a tax software, you need to find someone that can either track that down, or you need to kind of track that down yourself. So I don't think it's necessarily a threshold of a number of transactions, but I would say generally DeFi activity, if you're just on one exchange, you're fine. Like that's going to give you pretty accurate information if you put it into any crypto tax calculator or whatever, crypto tax software. But if you're doing multiple exchanges and or multi-chain and or DeFi bridging, any of that stuff, it starts to get complicated, and it's really hard for these tax softwares to track your basis. And that's where it could be a great advantage to you, because if it doesn't know your basis, it's going to assume it's zero. And so then you're paying taxes on the full amount of the proceeds rather than the gain, the capital gain that you have. So that's where it makes a big difference. So yeah, I guess to come back to your original question, I would say that if you're doing kind of more DeFi related activities, that's when it would be time to kind of find someone. But it can be expensive because it takes a lot of work to unravel this stuff. So if it's gonna save you $5,000 to $10,000, it might be worth it to kind of hire someone. Yeah, go ahead, Brian.
So Stacy, we might need a hierarchy of when do I need help with my crypto accounting? You know, do you have multiple wallets, multiple exchanges? You know, and that can be, it can literally funnel into when you need help.
Brian, hierarchy is not the magic word that makes me suddenly produce magical results.
We need a flow chart from Stacy.
You get one per year. Okay, one per year.
We need that's something we should probably put together. We should put together something of when do I need.
Yeah, that should probably come from tax accountants, okay,
Yes.
not me.
not an auditor.
Well, based on your idea, we should have like you know, some flow chart of when you need to know that you need help to make sure you're not losing your cost basis. Because I mean, you don't want to pay tax on money. Paying tax on money already spent is insane.
Yeah.
I was gonna say, Brian, I think you've hit the nail on the head there. Like we all join these talks and we provide some interesting content, but I think like a product and outcome from this could be, you know, like cheat sheets that say, hey, look, here's our advice when you need, you know, if you're just buying cryptocurrencies on Coinbase, you probably can use software, but if you're starting to get involved with DeFi, liquidity pools, NFTs, or whatever, if you've interacted with any of these, it's probably gonna save you money to get to get a crypto accountant involved.
Yeah, and I think that ultimately scale does matter. Like transaction volume doesn't matter, but if you've done DeFi activities and you've only done $500 worth of trading, it's not going to make sense for you to hire someone, right? Because like they're probably going to charge you around that amount to do your crypto taxes. So it probably makes more sense for you to just do it yourself. And if you get it wrong, like, you know, you're not going to lose that much money. But if you're in the, you know, tens of thousands of dollars of trading volume, it's almost always going to benefit you, even to probably do a look back, unless you really know what you're doing. Because I know when I first got started in like 2018 in investing in the crypto market, I didn't know what I know now. So I'm, you know, I know that I reported everything, but I probably over-reported certain things as well. You know, as you develop your skill set and as you learn more about the market, it can be advantageous to maybe take a look back as well.
Yeah, so we need a flow chart with rules, right? So if you have this and this,
like flowchart, maybe just a list of questions of like, you know, if you answer yes to more than 2 of these questions or more than 3 of these questions, then you need to get some software.
Yeah. Kind of like the you ever see the IRS roadmap where it tells you where your tax return goes and how they determine whether you get
audited? I don't look at IRS
stuff
stuff unless I'm like under duress, you know, like being forced to.
I like it.
But yeah, a flow chart would be good for this.
And yeah, I think so. And I think maybe even directing you to different types of tax software based on, you know, kind of reviews and based on what their capabilities are. Because like I said before, there's different tax software that can be very great and user-friendly for a certain subsect of people. And then other ones that will just maybe be too many features for them, but might be great for a DGen that's doing 10,000, 60,000 trades a year, you know? So we can have that flow chart that actually guides people to specific solutions as well. That's a good idea.
What help they need, right?
Yeah. Yeah.
That'd be perfect. That's a good idea. Yeah.
Yeah.
What do you mean by the term DGen?
Oh, so DGen is like so it's someone who's just like, I'll use another crypto. A gambler. So a degenerate.
Okay.
So like they're basically gambling on shit coins. They're like chasing after the next Elon Moon doggy coin, you know?
Okay.
Or, you know, Squid Game token or whatever. So they're the people who are literally gambling on all this stuff. And, you know, generally they have a lot more trades because they're, you know, chasing after the next pump and dump or whatever. Yeah. So what's that, Brian?
I'm kicking myself for not getting the Trump NFTs. They're up 5x, right?
Oh man.
Who was saying to me, or was pointing out, I saw some little clip of a video that was pointing out, they were saying, did you notice that with the Trump NFTs that they were going for $99 each and the limit was on like 100? So at most you could spend $9,900 on them, and that's below the limit of
8300s.
Oh, okay, yeah, 8300s. I don't know the tax form numbers.
Yeah.
And
I
so
don't
it
know.
was like someone was saying, like, it looks kind of like, and it's real easy to set up wallets to buy stuff and all that and fund it. So someone was saying it looks like a way of like basically contributing money or moving money around, or getting money to Trump outside of the normal channels.
That
Because
sounds on brand.
yeah, they were
Yeah.
challenging it. They were saying, like, has anybody looked into, I forget who was mentioning this.
Yeah. I don't think I mean, I can see where they're coming from, but I don't think that
Mhm.
it's so transparent that it would just be like, if he was doing anything criminal, it would be so transparent. They'd be able to track it down on the blockchain. I don't think it's money laundering. Like, I think a third party set up the Trump NFT and probably said, hey, we're going to do this for you. We're going to do everything and you're going to get a couple million, right? And now they're probably reaping all the benefits. Whoever set that up is going to reap all the benefits of the trading, the appreciation and value of them from their base value. That's
But
kind of
surely,
how I look at that.
surely 2022 is the death of speculation. I mean, the whole crypto space has been rife with speculation, and people are just pump and dumps. It feels like this Trump NFT is much the same. It feels like it's going to go up huge in value, but what's the utility of the NFT token here? What is the utility?
You get to meet him.
of
You get
this?
to have like a meet and greet with him, I think.
But what happens to the price after that? After that meet is done,
Yeah.
So
Yeah.
So he probably signed with a third-party NFT provider that has nothing to do with him. They said, "Hey, we'll give you $3 million if you let us sell an NFT in your name." And he said, "Okay, I don't think there's much complexity on his end with respect to the NFT."
What's that link you posted there, Brandon? Who
Um,
created it? So I guess, what about bringing it back around to the conversation about taxes? I guess a lot of people are reporting losses on their NFTs if they sell them for tax loss harvesting. Are there any other tax topics
so-
related to
The
so
other
there is
thing
one.
is the
Go
sales
ahead.
tax, right, Taylor?
Yeah, that's one. Well, that's one piece that we need to learn more about. But there's sales tax on NFTs in in a couple of different states now. Pennsylvania being one of them. To where if I'm not sure how the nexus works. I was hoping that there's what's his name, Patrick Camuso or something like that. He's been talking a lot about this on LinkedIn. I was hoping to get him. He's in the community. I was hoping to get him on this call to talk about sales taxes, but maybe another time. That's an interesting issue too, because depending on where you sell them from or where you sell them to, you might be liable for sales taxes depending on the state. So
And nobody's been doing that. So that's going to be another thing that the states are going to catch wind. The states are going to start chasing down all these NFTs that have been sold in the past 2-3 years for tens of millions of dollars.
yeah,
And they're going to want the little 5 to 7%, whatever the state tax is. So that's going to be a reckoning for NFT issuers.
Yeah. So that's an interesting part. As far as like, let's get back into some of the FAQs though for 2022 tax season. Another question that I've seen a lot is like, how is crypto income taxed? So crypto income is taxed just like any other income in the sense that if you earned income, it's going to come to you. If it's an employment type of thing where you have a W-2, it would come on your W-2 just as if it was paid in fiat currency. Now, The only difference being that when you go to sell that crypto, it's now a capital asset. So you would recognize a gain or a loss on the sale of that. So if you earned crypto as a 1099 NEC, then you would report it just like you would any other income, right? So it's another one of those scenarios where we need to kind of put on our critical thinking hat and be like, okay, what does this look like? And if it's income, right? Doesn't matter that it's crypto. The only difference here is that you'll have a capital gain or loss on the sale of that crypto to another crypto or to fiat. Another very frequent question I see is, what happens when Coinbase sends me a 1099? Like, does this mean that this is how much I owe? Well, ultimately, as I've kind of alluded to before, exchanges aren't capable of sending you correct tax forms because there's so many moving pieces here. They don't know your basis. So they're going to send you the information that they're going to send you and the IRS the information that they have for any tokens and coins that were transacted on their exchange. So while they may send this information to you, they can't certify the information within and say that this is definitely the correct info, because a lot of times they'll have missing basis info or whatever. So it's more of just an informational return to the IRS to expect some sort of crypto related transactions on your tax return. So that's that's a common issue I see with people is wondering kind of what happens when they get a 1099 from Coinbase or Kraken or Gemini or something like that.
You give it to your tax accountant. That's the answer.
Yeah, exactly. Close your eyes and stick your fingers in your ears if you're
Yes,
Stacy.
exactly. Pay this for me.
Yeah. Another one I wanted to kind of highlight. Another question. Go ahead.
I exaggerate for the sake of humor that I don't know taxes, but I understand taxes. I can't quote you the form names of IRS rulings and so forth, but yeah.
Yeah. And you know what? More power to you. You know what? I've been more of a tax guy and I can't stand audits. So you know what? We'll dig and we'll dong, right?
That's how it should be. We stay in our lanes and we do it together and we can provide everything for everybody,
Yeah. I'm just trying to pull up my post because I had another.
You don't want to prepare an attestation report?
No, thank you.
Agreed upon procedures? No
Yeah.
reports or expert opinions?
Oh, I think I remember that from the CPA exam.
Yeah, I had to learn it for a couple of days and then it went out the brain the other way.
Oh, yeah, I'm good at that. Couple days.
Okay, so a couple other questions. So what are some of the different impacts of like FTX collapse and came back in. What are some of the impacts of some of these major collapses in the crypto market in 2022? Celsius, BlockFi. What happens to the funds that users had on those exchanges? Are they losses to them? Do they have to just kind of bite the bullet? And this is an interesting one because ultimately these people are basically at the whim of the bankruptcy filings and the bankruptcy court, because ultimately they still have those funds. They don't have a loss quite yet because there hasn't been a decision made yet with the bankruptcy court. So you're kind of SOL. You're kind of shit out of luck in this scenario, unless you find a way to kind of formally abandon your crypto before year end. And you would have to kind of, I would assume you'd have to file some sort of form with the court or with the company themselves saying that you are relinquishing your right to that crypto. And there's not really that much time left in this year to be able to do that, but you would have to fully abandon your rights towards that to consider it a loss. And so that would mean that if it came out that people were actually getting paid back some of their funds that they held on these exchanges, you would no longer have that right. But that's the only real way to kind of recognize any funds held on these centralized platforms that were lost as a loss. So that's another interesting question that I think will cause a lot of pain this tax season, because a lot of people had massive gains, or even if they're not massive, they had gains that they were holding in some of these platforms to earn a little bit extra on top of. And when you and people are going to have to pay taxes on the earnings that they received but never will receive. So that's another really interesting, painful point this tax season. People earn rewards.
Why would the IRS ever like require you to pay tax on a gain that you never received because it's part of the FTX bankruptcy and you're never going to get the funds?
So
Well, because you had,
if
yeah, go
you
ahead,
don't have
Brian.
constructive receipt, you don't pay tax, right, on the gain.
Yeah.
If you have
Okay.
receipt, you'd have to constructively receive it.
But they did constructively receive it, and then they presumably left the rewards on the site and they didn't pull them out. They earned those rewards, and because they didn't pull them out and actually take them, that's not in the eyes of the IRS, that's not their fault. That's your fault for leaving them on that exchange. So if you earned it and you had access to them and you could have directed them at some point in time before the bankruptcy, you earned them, and that's income to you. So that's going to be a big issue.
The IRS is going to view it as constructive receipt because it was in your FTX wallet or account.
Mm-hmm. Yeah,
I can almost see specific guidance. I can almost see, revenue procedure or ruling where there's specific guidance on if you had an FTX account and you had this unfortunate circumstance and this is how you treat it. I mean, it'll probably take them a while to catch up, but it's a possibility.
yeah.
I mean, that just doesn't make sense that they would say like, oh yeah, you owe taxes on things that you lost. I mean, granted, yes, it was probably constructively received, but held on that platform. I mean, it's like, for instance, well, we could probably look at Bernie Madoff for like just some historical context and say, well, anyone who had like massive gains and they were holding it in a Bernie Madoff account, it wasn't actually there.
But
that's a good. That's a great idea to start researching what happened to people that had gains.
The difference here is that those were capital gains, right? Those were unrealized gains because those people hadn't sold those yet, right? So the difference here is that these are rewards that they were lending out their crypto and they were earning interest basically on it. So that is income rather than a gain that's unrealized at this point. Does that make sense? So there is a little bit of difference, but I think it's a good idea to look into this to kind of see the parallels.
So there's I don't know if this is a reliable website, but straightdope.com has a question from March 2009 about Bernie Madoff's victims, and it says, since it's confirmed that it's all a scam, will the investors get a refund on the taxes they paid from the false gains? And now this is granted more than a decade ago, but tax law doesn't change that much. It says some may find relief, but the law isn't always on the side of the investment victims. I keep this linked article in my bookmarks as part of my reference materials. And it's a Journal of Accountancy article, no theft loss for phantom income. So it's okay. So they call it phantom income, I suppose.
Oh, that's a cannabis reference, phantom income. But the other thing is too, with the casualty losses changed with the Tax Cuts and Jobs Act in 2017. You used to be able to take casualty losses for normal, like something goes wrong and you have a big loss. But they made it so it's only if it's a federally declared disaster or emergency that you can take a casualty loss after that. So things have changed a bit. But yeah, this is a whole nother topic that we can get into.
You're gonna have a lot of pissed off taxpayers this year, I guarantee that. Because I mean, by default, the IRS, any interest you earned on FTX is going to be considered income, and they're going to expect their cut of that, whether or not you have access to it right now. As a result of the bankruptcy.
There's a Journal of Accountancy article that is about obviously this situation has happened many, many times in the past,
right?
Where, like if I have a gain on my investments that are being managed and they bought and sold stuff on behalf of me, I have to pay taxes on those gains, right? Or losses or whatever. And so this is an article that's about in the 90s, actually, a case where they gave money to an investment manager who actually was running a scam. and they filed a refund claim for claiming a theft loss deduction under section 165A equal to their investment, fictitious income, and taxes paid. The claim was denied, went on into court. The government's position adopted by the court was that since there was no proof that the income existed, there could not have been a theft. As for the taxes, they could not be considered a theft either, the court concluded. The proper approach would be to file amended returns, but if, as in this case, the statute of limitations has run, the taxpayer is out of luck.
Oh,
Oof. Ow.
that's terrible.
Ugh.
So basically,
Ugh.
they pay tax on their gains, and then the 3 years went by and their gains weren't really gains, so they had phantom income.
So yeah, so if
When they're-
somebody has lost money in FTX, they need to figure out how they're treating it and make sure that they don't. I don't know, you tell me, does this make sense? I would go so far as to say, determine what the gain or loss that it is that's associated with your FTX. Like if you have gains that you were holding there in your FTX account, determine what it is, know what that information is, but do not pay taxes on it until you see how this all plays out. Because if you pay tax on it, it sounds like from this case, you're probably never getting that back. If you have, you know, 100,000 worth of capital gains sitting in that account, and now it's all lost and tied up in a bankruptcy, and you say, oh, well, I'm going to be honest, I'm going to go ahead and pay 15K of taxes on this, you know, for capital gains, let's say. I mean, this case seems to me like you're not getting that back.
Yeah, it seems like you have more options if you wait to file that. Now, whether you extend to like kind of kick the can down the road until, you know, October or whatever, or if you just file and then decide to amend in a couple of years, depending on how this kind of plays out. That's one way to do it. Now, whether or not that's considered fraud in the IRS because you're willfully not reporting something, I don't know. But that's an interesting thing to look into, whether or not you should. Because ultimately, in the eyes of the IRS, that's something that you should be reporting. So if you knowingly leave that off your tax return, that's an interesting thing.
You have to report it in the year in which you have determined there is no longer any reasonable chance of recovery. That's based on foresight, not hindsight. So you can't like do it looking back. You have to do it looking forward. Mm-hmm. And the Kaplans in this case, they waited until the bankruptcy trustee from this guy's scam had gotten back to them and said, there's no chance of you recovering. Mm-hmm. They waited. So that's why they didn't file their claims until 2001. And that's why the statute of limitations ran out. Bernie Madoff's bankruptcy trustee didn't get the whole thing. You know, they're just now, like I think in 2022,
I saw that.
Making the final payments. Okay.
Yeah.
So yeah, it sounds to me like you're better off just kind of like, if you think there's no chance of recovery because you're one of the small guys in there and you have absolutely no chance and you're already ready to write it off, then take that into account when you're figuring out what to do. You know, disclaimer, tax account.
This is why there's gonna be a great need for, you know, tax accountants and accounting professionals that want to serve this industry, because there's massive questions like this that people are going to need help with. Millions of users are going to need help with this this year. So I think advice like this, where we can kind of direct it at people and have a measured stance on it, and even if you file some sort of informational schedule as well, to say why you're handling things like this, you know?
You can do a protective claim, right? So if you do a protective claim on your tax return because you don't know how things are going to be treated, you can keep it past the 3 year or 6 year, you know, well, it's going to be 3 years. You can keep your return open past 3 years by filing protective claims every year.
Okay.
So, and that's something you do when you you know, there's no clear guidance on how the IRS is going to treat something specifically.
That's a good
And
idea right there.
yeah, protective claims. So, and you don't need to do it, right? So, because we're talking about it today and it's the end of 2022, we can file the protective claim 3 years from now to keep the returns open for what happened this year, you know, until it's figured out by the IRS going forward. So
Okay.
I think that that's one option for this uncertainty.
Interesting. Cool. Well, I have one more thing I wanted to talk about real quick, and we've discussed this on other water cooler Wednesdays, but I wanted to bring it up because it's going to be a big topic as well. Is kind of the tax implications around the merge of ETH from proof of work to proof of stake. And because we've done other full videos on this, I just want to kind of jump through kind of the too long didn't read the TLDR on that. And essentially, if you had locked your funds up in a staking contract beforehand, you've been earning rewards. And in my view, because you don't have constructive receipt of those rewards, assuming they're either in a solo staking or via a centralized exchange, I don't consider those income until you actually direct those funds. Now, the blanket statement from the IRS is that any staking rewards are ordinary income at the time received. But if you haven't constructively received those rewards because they're locked in the staking contract until the Shanghai upgrade, which is supposed to be coming in March, I don't consider that income. But another kind of key thing is the ETH proof of work fork. So from the merge from proof of work to proof of stake, there were some miners that decided to spin off the old proof of work chain. And as a result, any users who had non-custodial ETH in their wallet were airdropped ETH W tokens, which were worth, I'm not sure exactly how much they were worth at the time of the airdrop, but they were worth something. So you're going to have ordinary income related to that. A couple of other kind of quick scenarios are things like liquid staking. An example is Lido's staked ETH. So staked ETH is backed by actual ETH in a staking contract, but it's a separate token that is tradable, and it earns a reward whenever those rewards are distributed. You can claim those on the website as they are earned. So that is ordinary income because it's available to you and you can constructively receive it. However, there's another type of liquid staking called RETH, Rocket Pool's RETH, and that accrues the rewards within the token value. So that's going to be treated as just a capital gain. You have more ability to control your taxable outcome because it's only taxable when you sell it, because you're creating that capital event, that taxable event by selling it. So I think I covered the main scenarios there. The actual merge from proof of work to proof of stake did not create a taxable event because it was just like an airplane in midair having the engine taken out and replaced. Like it's the same airplane, it's just the engine's different. And so the asset itself didn't change from that transition, just the consensus mechanism that operates it. So the event itself didn't cause any, but there's a lot of indirect kind of tax implications surrounding that. So that's kind of the TLDR on the ETH merge. And that was kind of the last thing I wanted to highlight there. I didn't know if anyone else saw any other kind of scenarios surrounding the ETH merge that they wanted to talk about that are potentially taxable.
Your blog post covers all the details, you know, so
Yeah.
as long as
I have a
people know
blog post.
that exists, then they'll have some pretty good guidance.
Yeah. Cool. Well, we're almost up on an hour, so I appreciate everyone joining the call today. We don't have a topic outlined next week quite yet. I think that we've got a couple in the wing that we're deciding on, so we'll announce that in the next couple of days. But if I don't see you guys before the new year, Happy New Year, and thanks again for joining. We'll see you in 2023.